The Federal Reserve's FOMC meeting just wrapped up. What is the Fed seeing in terms of inflation, economic growth, and risks to the U.S. economy? In this video, we'll look into key economic issues, including unemployment, inflation, the current state of the yield curve, and most importantly, for the average American, real wages. So this Fed meeting was actually quite newsworthy, in my opinion. Now, not from the decision for the overnight rate; they kept that the same, and they also kept their estimate for the number of cuts for the year of 2025. They also kept that the same. They are still seeing 50 basis points of cuts, but there are some more interesting trends starting to emerge, and I think that the Fed might starting to be picking up on, which we will go into here. So they removed a statement about a risk of higher unemployment and higher inflation. They removed that. They did say here, highlighted, uncertainty about the economic outlook has diminished but remains elevated. So things have gotten better, but the risks remain elevated, which I would say is probably an accurate statement. They say that they are attentive to the risk to both sides of their dual mandate. Their dual mandate, the Fed's mandate, is stable prices, so stable inflation, and full employment, so low unemployment. Those are the two sides of the Federal Reserve's mandate. And they have previously said, Chairman Jerome Powell has said that some of the policies of the current administration put those goals in conflict. We'll get into all of this in a second. Here is the summary of economic projections. We got a new one of these. One of the reasons I think that this meeting was so much more kind of important or noteworthy, one of the reasons we get a new summary of economic projections, I will put a link to this in the description. Here we can see the current estimate for real growth, real GDP, unemployment rate, PCE, inflation, this personal consumption expenditure inflation. This is just another way to measure inflation, as well as the federal funds rate. So a couple of things that I think are interesting. They lowered their growth forecast by 30 basis points. For the year 2025 and 2026, they keep their 2027 and longer run growth estimates the same, but they lowered their 2025 and 26 estimates for growth. Unemployment remains relatively unchanged, around 4.5%. PCE inflation, they also raised, right? So back in March, they had forecast, the last time we got a SEP, what they had forecast 2.7%. For PCE inflation. Well, that has gotten raised to 3%. And for 26, they had seen 2.2, and now they see 2.4. Hopefully this makes sense as I go through it. Another interesting piece is that while the committee sees 3.9% as the federal funds rate for the year 2025, indicating 50 basis points of cuts, while they see that, and that has not changed, they do see a higher federal funds rate for 2026 and 2027, which I think is interesting. So here goes through each of those individual components. Here you can see GDP. They see it falling for the year of 2025 before kind of recovering gradually. There is a relatively wide range in the projections, as you can see by the blue bars. Unemployment, not really noteworthy. They see that remaining about constant, around 4%. PCE inflation here, they do see PCE rising from its 2024 level before eventually falling. As you can see, the red line indicates the median projection, which I think is interesting, the most interesting. But sometimes the range of projections can also be interesting, as we'll see with the dot plot. There is, a significant range for the year 2026 in terms of inflation. While the median forecast is, relatively low, around 2.2%, you can see that some of the estimates go, up to 3 or even slightly above 3%. So the blue bar, sometimes that range can also be instructive as well. Core PCE is just another way to measure inflation. Here is the dot plot. This shows each voting member of the Fed. This shows where they believe the appropriate policy rate, the overnight interest rate that they control. And this shows each one of them for the year 2025. This is how they voted. For the year 2026, this is how they voted. And for the year 2027, this is how they voted. Again, there is some change to that from March, where for this year, there's no real change in their outlook for the neutral policy rate, but they do see the rate 20 basis points higher for 26 and 30 basis points higher for 27. And I think that they are starting to pick up on some structural issues with the economy, with politics, with society, and we'll get into that right now. So here in white, we see the unemployment rate. As this white line is going down, this means the unemployment rate is lower. And then in red, we have the fiscal deficit. This is the difference between what the government spends and what it collects in revenue through tax. As a share of GDP, that fiscal deficit as a share of GDP, and then we flip it upside down and invert it. What you can see here is that we have never run such a large deficit with such low unemployment. This is called a pro-cyclical deficit. And we are engaged in this pro-cyclical stimulus as if we were in a world war or a sharp, deep recession, when in fact we're not. When in fact unemployment is, at least measured by the headline, relatively near historic lows. And inflation has been declining, as we'll take a look at in a second. If there is any risk to inflation, it is this. It is the continuation of utterly insane deficits that we have been running for the past 4 or 5 years. Made sense in 2020 and maybe even 2021, right? But they have not come back down to an appropriate level of, say, 2 or 3% of GDP. They have remained very elevated. If anything is going to cause inflation, in my opinion, it is this. He was asked about this dynamic and the fiscal spending, and the kind of profligate government spending. He was asked about this and kind of ducked the question, which I think eventually he will have to admit. Remember, inflation is a monetary phenomenon. Running such large deficits, there is a consequence to that. Here in blue, I do want to point out the U6 unemployment rate. This is you won't hear this rate reported much, but this starts to include other components, right? This includes part-time workers that are only part-time because of economic reasons. It includes discouraged workers, and this indicates an unemployment rate of 7.8%, which is significantly higher than the kind of headline number that you will hear reported on the nightly news. Here is inflation in white. So in white, we have CPI. This is the one most people are familiar with. And then in red, we have PCE. Remember, the Fed mainly talks about PCE, but you can see that, directionally, they are identical. The trends are identical. The only difference is kind of slight calculations for how they actually calculate the inflation can result in a variation between CPI and PCE. As you can see at the peak here, CPI was over 9% and PCE was about 7%. The point here is inflation has been falling. We have been, we had a period of very, very high inflation for sure, but it has been falling. And falling, I would argue, pretty consistently. I'm starting to think that inflation has bottomed or is very close to bottoming. Part of the reason I believe that is looking at the tax bill, the current kind of spending bill, and how large the deficit is going to be under that bill. Remember, this kind of thing, just like we saw over the past 4 or 5 years, is very stimulatory. It's going to cause inflation. There is no two ways about it. And originally this administration had ran on kind of dramatically reducing the size of government, trying to balance the budget, cutting government spending, cutting waste and abuse, right? All those things. That's what they had ran on. And they get into office, they cut $150 billion, if you believe their metric. That's like 1% of the total federal budget, like 1 or 1.5% of the total federal budget. It's just nothing. They cut next to nothing, and basically had to give up, right? And now they're pivoting towards this kind of identical profligate spending that we saw under the last administration. Well, that is bullish for inflation. There's no way that does not cause a rise in inflation. We have been in a disinflationary trend, but these pro-cyclical deficits will drive inflation so long as they continue. Here, I want to show wage growth as well. So remember, when you hear on the nightly news someone like Lawrence Summers talk about inflation, they see wage growth, your wages, they see that wage growth as a negative. They see that as a negative. So just remember that. Wage growth, as you can hopefully see, is very tightly correlated to inflation, and at least directionally. There is something called a wage price spiral. This is where it kind of gets away from them. Wages are increasing, inflation is rising, and it kind of becomes a spiral that they cannot get out of. That is certainly a dynamic that is worthy of recognition. But what they never seem to mention is that wages have been trailing GDP growth. Wages have been trailing money supply growth. Wages in real terms have been falling for the average American for at least 20 years, if not 30 or 40 years, depending on how you measure it. This is super important. So, as you can see, the correlation with wage growth between wage growth and inflation is very tight. But I think that to the risk of inflation, the upside risk of inflation, there is a world. I just want to remind people where inflation, say, CPI currently 2.4%. There is a world where, say, CPI doubles and it goes to 5%. There is a world where inflation is doubling from its current level, but the average American is actually getting wealthier. And if growth is outpacing inflation, I argue that CPI or PCE are not accurate ways of measuring inflation. But so long as wage growth is outpacing kind of real inflation, the average American is benefiting. They are getting richer. So I think that should be pointed out, because I think that what we are seeing is a shift structurally, societally, not just here in America either, also in Europe, towards more kind of populist policies. One of these, I want to break down kind of two main points with this. The first one is with globalization. So, one of the things that kept unemployment low and CPI low, inflation low. One of the ways that we did that over the past 3-4 decades was increasing globalization, increasing global trade. That was very, very good for people that own financial assets. That was very, very good, right? Their margins expanded, corporate profits surged. It's very good for them. It was also very good for the people, the top 1% that hold their wealth in financial assets. But the average person got kind of screwed, like really screwed. What we've been starting to see, I would argue it's going back, 5, 6, 7 years, is kind of an uprising, a populist uprising against that. There's two main points that I think there's an uprising against. The first is globalization. So what I argue is we've seen peak globalization. And from here, the pendulum will start to swing the other direction, which is in the direction of, you can call it deglobalization, reshoring, friendshoring, whatever that may be. Well, that is inflationary. There's no two ways about it. That is inflationary. This is one of the reasons I think that the Fed is starting to maybe pick up on some of these trends. The other point that I think is worth mentioning is not just globalization and kind of a widespread revolt. The bottom 90% did not benefit from globalization. Not only that, but also immigration. So I'm old enough to remember when Democrats were kind of seen, generally speaking, as the party of the working class. And one of the things I remember as a young, 11, 12, 13-year-old that was starting to get interested in politics, was their stance on immigration, which was, I don't want to say it was maybe as harsh as the current administration stance, but it was harsh. Because they recognized that, remember, when you're talking about wages and you're talking about the labor supply, it is different than anything else. It is a supply and demand equation. If you dramatically increase the supply of supply of labor through immigration, through mass migration, especially from very, very poor areas, when you do that, The release valve between that supply demand imbalance, the release valve is wages. Wages go down. And this is one of the things that the Democrats accurately identified in the late 90s and early 2000s was this effect of depressing American wages via mass migration. I think, currently we know the current administration is kind of very hardcore on this particular point. And at least from an economic standpoint, there is justification. If your goal is to raise the bottom 90%'s wages, then they are taking the right path, which is to decrease the illegal labor supply that has an impact on wages upward. A lot of people always say, well, yeah, but Americans won't clean a hotel room in Alabama for $9 an hour. No, they certainly won't. But you take that to 15, 20, 25, 30. I don't know where the release is. I don't know where the supply demand imbalance comes into balance, but there is a wage. There is a price at which an American would be willing to do that job. And it is certainly much, much higher than we currently see. So I think that we will see this kind of reemergence of a maybe not as anti-immigration as the current administration is, but I think the left will kind of reinvigorate a more sane approach to immigration than we saw in the last administration. Well, both of those policies, right, kind of anti-globalization or peak globalization, as well as this kind of immigration story and the way that it has depressed American wages for decades, I think both of those things are part of this kind of general populist uprising that you're seeing not only in America, but also in Europe. I mean, both of those key pieces that we just mentioned, it's not just being talked about in America, it's being talked about in Europe. I mean, you famously had Keir Starmer say globalization failed the bottom 99% of Britons. And he's right. Like, just objectively, I've done many videos. It is just, it is provably true with the data that we have that globalization exclusively benefited the top 1%. And I would argue even smaller, kind of, the top 0.1% at the expense of the bottom 99. And so I think you're going to see continued kind of uprising against both of those key pillars of kind of the predominant bipartisan consensus over the past few decades. I think you're going to see a revolt against both. Well, both of those things are inflationary. Just as increasing globalization was disinflationary and helped kind of lower inflation, well, if you start to go in the opposite direction, that is certainly inflationary. As you reshoring is going to cost $10 trillion at least. This is inflationary. Reshoring and deglobalization is inflationary. So is decreasing the illegal labor supply, which has been depressing American wages. Doing that will cause American wages to go up. Well, as we can see here, this drives inflation. Inflation is headed higher, in my opinion, from a societal level due to these two pieces. Once you start to add in the third piece of this kind of fiscal side, right, what the government's spending and the fiscal deficit is looking like, you have three overwhelmingly positive, impulses upward in inflation, in my personal opinion. However, again, there is a world where CPI is 5%, but wage growth is 10, right? And in that world, we have all been kind of so scarred over the past 5 years with inflation. We have all been so scarred, that we hear inflation and think, oh my God, that pain was too much. We can't go through that again. Well, there is a world, right, with the right policies, and I don't really trust politicians to pull this off, but theoretically, it is possible to have rising real wages. With the right policies. And I do believe that decreasing that we saw kind of peak globalization. I do agree that we should work to reduce the trade deficit. I also do agree that we should work to decrease the illegal labor supply, which has been depressing American wages. I do agree with the core tenet of both of those. And I think that while that is currently seen as a Republican thing or a position of Trump, I think that you will see that starts to shift. I mean, I remember Bernie Sanders and Dennis Kucinich talking about the fears of globalization and how it would concentrate wealth, how it would depress American wages. They were correct. All those pro labor Democrats were correct in the late 90s, early 2000s. They were also correct with the effect that mass migration would have on American wages. I think that the left will there will be a reemergence of both of those pillars from the left. So I think that this is not limited to political party. I see this over the next decade or decade and a half. I see this being kind of the predominant thing when it comes to both of those pillars. Well, that's inflationary. There's no two ways about it, especially once you add in the fiscal side of the equation and these kind of utterly insane pro-cyclical deficits. It is just even more rocket fuel for inflation. So where here is, hopefully this will look familiar to anyone watching my channel. Here you have nominal growth in white, and then we have the cost of the debt. I have four different maturities here: the 2-year, the 5-year, the 10-year, the 30-year. One of the things when it comes to interest rates that I think is important, that is the most important, arguably, is this directional trend down in nominal growth. Remember, as long as you can keep the white line above the cost of your debt, you are okay in terms of debt. Uh, what we've been seeing is kind of a 4 or 5 year trend upward in rates, downward in nominal growth. This eventually, I'm not saying it's imminent, but this will eventually get to a point where the debt burden starts to really kind of hurt on the government. And what we're seeing, here, the 30-year has crossed over nominal growth. Right now, the 30-year is 4.7%. Nominal growth is only 4.4. The 10-year treasury is currently, this is slightly lag data. The 10-year treasuries are, right there at like 4.39, is right at nominal growth. So if long-term rates, if the cost of the debt continues on this 4 or 5 year trend, which you can really see at the long end of the yield curve. I will take off the shorter maturities. You can really see this upward trend very clearly. And again, this is partly due to the pro-cyclical deficit that both parties seem intent on running. When the cost of the debt goes above nominal growth, you start to have issues. Again, when those issues arise, how do they deal with them? They print money, they might have a fancy name for it. They might call it something, some new acronym, but it is inflationary. Eventually, long-term rates will get to a point where the government, the debt burden is too much for them and they have to print money to QE or yield curve control or whatever term you want to use. That is also inflationary. So now you have 4 drivers up in terms of inflation. I think that this will matter in the short to intermediate term. I think the debt and the deficits will matter. Here is the entire yield curve. Not every single maturity, but a good idea. You have the 3-month all the way out to the 30-year. And hopefully the color scheme makes some intuitive sense. It's kind of darker going out the rainbow. What I want to illustrate is what's called the steepening of the yield curve. So when the Fed started to cut here back in September of 2024, look at when when these longer term rates bottomed. Right, they bottomed right before that first cut. As soon as that first cut was made, I'll take off the shorter maturities to hopefully make it slightly easier to see. I'll take off the 3-month as well. My computer will cooperate. You can see that the from the minute of the first Fed cut, that was the bottom in the 30-year yield. That was the bottom in the 10-year yield. That was the bottom in the 5-year yield. And ever since then, the 5 is kind of popped up and has kind of been going sideways. But as you can see, the longer you go out in maturity, the more of an uptrend you start to see. What that's called is a steepening of the yield curve. And here we can see that kind of represented in a way. I think it's important to mention, a lot of people are pointing this out. There were quite a number of cuts, including this jumbo 50 basis point cut. And I want to show what inflation was in September. It was significantly higher than we're seeing now. So when that first cut was made here in September of 2024, inflation was 2.6%. And then when the second cut was made, inflation was 2.7, 2.8, 2.9%. We are currently all the way down to 2.4, 2.3. depending on the metric you're using. So inflation was higher when these cuts were being made, these jumbo cuts. But the point here in terms of the debt is that is when yields bottomed. Was right, as soon as they made that first jumbo 50 basis point cut, yields have only gone up, right? You would expect, hopefully intuitively, the Fed cuts the overnight interest rate. You would think uh, all interest rates would decrease. And generally, that is what's happened in the past historically, but that is not what we've seen here. We saw that was actually the bottom in the 5 year, the 10 year, the 30 year, and rates have only been headed higher ever since. One way to visualize the yield curve is to do a spread where you take a long maturity and you subtract the yield for shorter maturity. This particular curve is the 30-year yield minus the 2-year yield. I'll put a horizontal line so that we can see about where 0% is, about right there. Anything below this dotted yellow line, when the white line is below the dotted yellow line, that is what's called an inverted yield curve. This means that even though it shouldn't be this way, long-term rates are actually lower than short-term rates. This, you've probably heard this talked about pretty breathlessly. I won't go into a ton of detail, but what is interesting is that the 32 or the 10 minus the 2, whichever spread you want to use, that bottomed right before the Fed's first cut. And ever since then, the curve has been steepening. When you start to think about all those structural drivers of inflation, all the societal drivers and kind of political and all the stuff we were just talking about, when you start to consider all these things, and then you start to put into the picture the debt and the kind of debt picture of the United States, and this kind of starting to become an issue. Once you add all four of those pieces together, in my opinion, what you have is a steepening of the yield curve. I said that the yield curve would steepen, I think, in July of 2024. I believe it continues to steepen from here. And here in red, by the way, is the federal funds rate. You can see that as soon as they started cutting, the yield curve steepened notably. It was kind of chopping around for about 6 months or so, but as soon as they started to cut, especially a 50 basis point cut, yield curve uninverted and steepened notably. I think the yield curve continues to steepen from here. Eventually, remember, the real things that real Americans, a credit card, a car loan, a mortgage, especially, these are priced not off the overnight interest rate. They're priced off of long-term bonds like the 10-year or the 30-year yield. And, if you get into a world where long-term rates continue to move higher, you can cut the short rates all you want. You can issue debt only at the short end all you want, but long-term rates will continue to drift higher due to these structural drivers of inflation. Eventually, that breaks the housing market. Housing market is a large component of the U.S. economy. So my take on this is kind of long-term rates continue to go up from here. The yield curve continues to steepen from here until eventually the long-term rates get so high that they have to come in with some sort of yield curve control, quantitative easing, whatever you want to call it. Again, this is yet another kind of pillar that is driving this inflationary outlook that I have. Okay, so here's the average hourly wage. Here is what you will hear reported on the nightly news, this red number, this white line here. And it looks very, very strong, right? Wages are growing. Okay, this is great. Well, let's compare it to how fast the economy has grown. Let's take the average hourly wage and divide it by GDP. What do we get then? Oh, it's really bad. Oh, look, wages have been trailing GDP for like 70 years. This is what I'm talking about. So when I talk about real wage gains, this is kind of one way to think about it. The average GDP has been growing faster than the average hourly wage as far back as the data, which is 1964. This entire period of time, we have an asymptotic trend towards zero. Um, this cannot continue forever. Eventually, this gets to a breaking point. I think we're starting to see that kind of socially, politically. Eventually, this gets to a breaking point, and the average hourly wage must increase faster than GDP. Right? Remember, they talk about GDP as if we're all benefiting, at the rate of GDP growth. Well, this red line shows that we are in fact not all benefiting from that wonderful GDP that they always talk about. This red line must go up. If it continues on the current trend that it's on, it can do that. I don't know, maybe 4 or 5 years, maybe six. I don't know. But eventually you have Marie Antoinette like scenes, right? Eventually it gets to such a breaking point that the people just completely revolt. I hope we never see that point. I hope we're able to do it constructively through good, smart policy that will benefit the bottom 99%. I'm hopeful for that. However, I have very, very little faith in basically any politician to actually make that happen. But I think that this disparity between a nominal figure versus this kind of real figure, right? And I've shown countless different ways to look at this. You take personal income divided by the money supply by divide by M2. All these different ways of looking at the average American showed the same picture, which is the average American has been getting just absolutely crushed and has not been enjoying the very strong kind of GDP that they always talk on the nightly news about. Well, this trend can reverse, right? It's been going since 1962 or three or whatever my data said, but that doesn't mean that it can't reverse. And I think that we're in a fourth turning sort of world demographically, from a kind of structural demographic theory perspective, as well as from an economic and kind of financial perspective. I see all these pillars kind of aligning, where I think that this line over the next 10 to 15 years will start to increase because the average person can't really take much more of the pain that they have felt over the past few decades. So here is a brief overview how markets reacted to it is now closed. Market is now closed. The S&P closed flat on the day, down 0.02%, basically flat on the day for the S&P. Volatility did initially spike, but the volatility closed down for the day. Oil continues to look pretty strong. This is geopolitical related, and you can see yields. Bonds had got bid, yields had come down initially on the result and the initial press conference, but then that move was reversed. And you can see that yields moved higher. This means bonds got sold. So yields moved higher again, especially at the long end, like this 30-year bond here. I expect higher rates until eventually they get to a point where they have to come in and kind of do an operation twist sort or yield curve control or QE sort of perspective, plan operation. Issue short debt, right? Cut the overnight rate, bring the short-term interest rates down, issue all the debt there, very inflationary, and use that money to buy your own long-term debt to bring the rates down. I think that that's inevitable. I don't know when it comes, but that is also inflationary. Again, that's kind of the fourth pillar in my kind of inflationary outlook. Unemployment. I'll also say this. Unemployment has never done a dynamic where it makes a bottom, increases slightly, right? It set a bottom back here in 2023, and has been increasing ever since 2023. It has never done that and not had an exponential rise. I will take off the fiscal deficit to make it even more clear. It doesn't generate, I can't find an example where it bottoms, starts to increase ever so slightly, and then just kind of peters off. I can't really find an example of that in this data. So I think that there is a possibility that the U.S. goes into some form of kind of recession, at least in terms of the real GDP. I think that tariffs are more disinflationary than inflationary, and I think that there could be a negative demand shock from the tariffs and from kind of global uncertainty, especially once you add in the geopolitical issues, right? There is a risk of a recession, I think is relatively low when we're running a 6% deficit, as we saw before. I think the risk of recession is low, but again, unemployment has never made a bottom, moved slightly higher, and then just kind of petered off. So if unemployment spikes and does what it historically has done and spikes higher, you would see the Fed come in, cut the overnight rate. You would see probably QE, but I think long-term rates would go up in that scenario. And I've outlined my thesis on that pretty extensively in another video. Why the U.S. cannot afford a recession, I would recommend that. But anyways, That's kind of my takeaways. I think this one is, I think the reporters are starting to get frustrated with Powell. I got that distinct impression today. They also mentioned the end of Bretton Woods and why he is kind of pretending like everything's just going on the way it has for the past 70 years. Someone asked him, it seems like the entire structure of kind of the global financial system is starting to change. Why aren't you talking about that? And he dodged the question kind of predictably. And they also asked about AI. And again, he kind of dodged that question. But there is, to add another pillar that kind of counters my four pillars for inflation, to add a kind of counterweight to my four pillars for inflation. There is AI and technological deflation. But again, I think that that gets into a point where so many people are unemployed due to it, and the cost of administering the benefits to those unemployed, that I think the deficit goes up. Even if we see kind of this rapid technological advancement, I think there's a chance that we actually see the deficit go up. I mean, we know how kind of grossly inefficient bureaucracy is. It would, the amount of money that it would cost to administer the UBI program would be, 10x, right? So I could see the deficit going up in that sort of scenario. You also get into kind of a potential risk of debt deflation and the value of the collateral. If that starts to fall too quickly, the entire system implodes because we're 10, 15, 20x levered. So they are starting to mention some of these kind of bigger issues like AI, immigration, the fiscal spending and profligate spending, the dollar, and all the things we've been talking about for the past few months. It is starting to kind of be talked about officially in the Federal Reserve's press conference room. So I think that that's pretty cool. And yeah, we will keep an eye on it. But hopefully that was helpful. It's just my personal opinion on all of this, not financial advice. But anyways, I will catch you in the next one.